All right. Today's training is on how to do the discovery call for an IUL appointment. Obviously, what we're going to do is create this picture in the client's mind of what an IUL can do to help them, help their family, protect them, and how to grow their cash value to be able to supplement a tax-free retirement. So what I'm going to do here is kind of go through how I would take a call in a discovery, and then I'm going to share my screen with you and show you exactly the questions that I ask, what I write in the questions, and what I actually say to the client when the client is on the phone with me for the actual discovery call. So usually when a client calls, they want to know what an IUL does. They've seen an ad on Facebook or Instagram, and then they fill out the form. Most people just don't go out there and fill out a ton of forms. What they're interested in is one of three things. I call a client that has already set an appointment with me. That next appointment is going to be the discovery call appointment. The first thing that I'm going to ask them is an open-ended question because every client is different. Number one. Number two, the answer that they give me is what I'm going to base my next question on. Number three, I want to make sure that they start talking as soon as possible. When they start talking, now they're comfortable. The more they can divulge what their purpose is or what their reasoning is, their need, their pain, the more they will feel comfortable with having an intelligent conversation with me. And so I might ask an open-ended question, something like this. I'd like to just open it up to you, Mr. Jones, and ask you, what got you interested in the IUL? That's an open-ended question, but it may not receive an open-ended answer. They may come back and say, well, I seen it online and I wanted some more information. That means that I need to ask a better question. If you ask a better question, you're going to get a better answer. Okay, Mr. Jones, no problem. I totally understand. I'm sure you don't go around and just fill out forms online. When you saw my ad about the IUL, what intrigued you to fill out the form and schedule an appointment with me? That's a better question. So now they may say one of three things. Most people, when they fill out that form, want to know more information about either tax-free growth, living benefits, or just a life insurance policy to protect their family. Let me do this again. They may say, I'm going to ask them in the question, I'm going to say, Mr. Jones, when you saw the ad on Facebook or Instagram, I know you just don't go fill out every form there is out. What intrigued you about the IUL to fill out this form to get more information from me and get on my schedule? Well, I saw that this product will grow money tax-free. Yes. Now, I'm not going to ask the next question about living benefits. Why? Because they're interested in tax-free growth. So I may ask the question next, where do you have your money at right now? I'm going to start talking about investment. Now, let me go back. What if I ask that question, hey, Mr. Jones, you just don't fill out forms online all the time. When you saw my ad, what intrigued you to fill out that form and get more information on the IUL? They may say, well, I saw that it has living benefits with a life insurance policy. And of course, I'm going to say, yep, it does. The next question may be, do you have any type of life insurance product in place right now? And if they say yes, then I'm going to ask them, what type of coverage do you have? Is it a term? Is it a whole life? So we're basically going to base our next question off of what they answer us. There's no script for that. It may be something off the wall. It may be one of those three things that I just talked about, which the majority of the time it is. But if that's the case, they may come back and say, well, I'm interested in protecting my family. Okay, perfect. That may not necessarily be an IUL lead. It may be a term. It may be a whole life final expense policy type of lead, because they may not qualify for an IUL. But based off of what they give you as an answer is what your next question is going to be. Let's go back to the client that says, I'm interested in tax-free growth. The first thing I'm going to do before I even ask the question and I get the lead is I'm going to write down their name, Joe Jones. And then I'm going to write down the state that they're in, California. And then if I know a phone number, anything like that, I may write that down right here. And then their email, Joe Jones at Gmail. Okay. And then what I'm going to do is I'm going to ask the question. Let's go through it again. The first question I'm going to ask them is an open-ended question because we want them to talk. Mr. Jones, when you saw my ad on Facebook or Instagram, I know you just don't go fill out forms all the time. So what intrigued you to fill out the form and get on my schedule about the IUL? Well, I saw that it grows money, and I guess that's tax-free, right? Yes, it does. So I'm going to put down here tax-free growth. Now I'm going to ask them another investment question because they gave me an investment type of an answer. Where do you have your money at right now? Do you have it in stocks, bonds, mutual funds? And notice that's way down here because we're not going to use the financial inventory to go in line. We may, but maybe we don't. It just depends on how the client answers the question. So I'm going to ask the question, what do you have that acts as life insurance right now that would go to a beneficiary when you die, like an investment type product, like 401ks, IRAs, stocks, bonds, mutual funds, any CDs, any Bitcoin, real estate, anything like that? No, I don't have anything like that. Okay. And so I'm assuming that's one of the reasons why you're on the call with me? Yes. Now I have to ask you some questions here to determine if you would even qualify for it. And then I'll explain what the IUL does for you. Is that okay? Sure. Okay. I'm going to take 5 minutes, ask you some finance questions, take 5 minutes, ask you some health questions, and then we'll go from there. Okay. Yes. All right. Do you own your own home right now or do you rent? I own my own home. Perfect. How much do you pay for your 2000 a month? Okay. Do you know the total payoff on that? Yeah, it's somewhere around 200,000. Okay, cool. And then do you know the value of the property? I'm not quite sure, but it's about 350,000. So you have about 150,000 of equity there. I'm sure that if you pass away, you'd want that to go to your family, right? Yes. So if I designed a policy that would encompass everything for you, that would pay off the mortgage if you were to pass away or possibly even get hurt, sick, or injured, would that be of interest to you as well? Yes. Okay, so I'm gonna make it a little note, pay off mortgage. How many years is left on your mortgage? Well, we just took it out a year ago, so I think 29 years. Okay. Oh, so you just purchased this, you said, correct? Yes. Do you pay anything extra per month on the mortgage to pay it off early or no? No. And you mentioned you don't have a 401k, IRA, nothing like that, correct? Nope. What do you do for a living? Well, I work construction. Okay. What type of construction? I'm a carpenter. Do you own your own business? I do. Okay. And so you don't have a 401k or anything like that through your own business or a SEP 401k or a SEP IRA, nothing like that. Nope. Okay. And then what is your monthly income? Somewhere around 10,000. Okay. Now I know I should have asked you this earlier, but are you married, single, divorced, widowed? I'm married. Okay. And then what is her name? Diane. Same last name? Yeah. Okay, cool. How long have you been married for? Couple years. Got any kids yet? Nope. No kids. Okay. Break the ice a little bit, right? What does Diane do for a living? Well, she's a nurse, like an RN. Yep. Okay. And then what is her monthly income? Her monthly income, I'm not quite sure. I think it's about $5,000 a month. Okay. Cool. So between the both of you, about 15,000 roughly. Yeah, that sounds about right. Okay. If you were to add up your monthly expenses, I don't need to know every bill that you have, but if you were to add up your mortgage payment, car payment if you have one, gas, insurance, utilities, food, Netflix, any credit card payments, anything like that, what would that add up to be per month? Well, we probably spend with all of our bills and our car payment roughly about $8,000. So by my math, that leaves about $7,000. Is that correct? Yeah, that sounds pretty close. Okay. Do you have any type of life insurance product in place right now? No, I don't. Okay. How long have you been looking for life insurance? Well, I haven't been looking too long. Really? What made you want to look into the life insurance now? Well, I saw the ad about the IUL, how it grows cash value. I figured I need some life insurance, so maybe we'll kill two birds with one stone. Okay, cool. What prescriptions are you currently taking? Well, I'm on just a high blood pressure medicine. What's the name of it? Lisinopril. And then any other medications? No? How about any medications that the doctor put you on that you stopped taking in the last year? Yeah, they had me on some type of cholesterol medicine. Was it a torvastatin? Yes. By the way, how old are you? I'm 50. Okay. When's your birthday? 9/16/75. Height and weight? 5'9", 200 pounds. Any tobacco products in the last year that you've used? Nope, I don't do that. Okay, cool. And then how about Diane? How old is she? She's 49. Okay, and then when's her birthday? 11/13/1976. Okay. And then her height and weight? I think she's 5'7". She probably weighs 140. Any tobacco products? Nope. Okay, now, are you looking into the IUL for yourself, for your wife, or for both? For myself right now, possibly could be both of us, depending on how this plays out. Okay, perfect. So I'm going to put a star here, star here. That way I know in my mind that he's possibly looking for both. Okay, and then what prescription medications is Diane taking? Well, I don't know, to be honest with you. She just takes them every morning when I'm not around. Okay. So I'm going to just put a question mark here. And then, have you ever had a heart attack, stroke, mini stroke, cancer, any stents, any diabetes, neuropathy, high blood pressure? Well, obviously you have the high blood pressure, but anything else? No. Okay. Any lupus, rheumatoid arthritis, asthma, COPD, any thyroid medication, anxiety, depression, anything like that? No. Any kidney or liver disease? No. Okay, cool. How about any hospitalizations or surgeries in the last 5 years? Any of those? No. Any felonies, misdemeanors? Yeah, I had a misdemeanor. How long ago was that? That was about 6 years ago. Okay. And then were you on probation for that or what happened? Nope, no probation. I just had to pay a fine. It was just a minor misdemeanor for marijuana. I've since stopped smoking. Okay, cool. And then any moving violations, DUIs, anything like that in the last 5 years? No. License isn't suspended, right? Nope. Okay, cool. All right. And then how about Diane? Has she had a heart attack, stroke, mini stroke, cancer? Nope, she's completely healthy. She works out every day. She's stout as a brick house. Any surgeries in the last 5 years? Nope. Any felonies or misdemeanors? Nope. Any moving violations? Yeah, she has 2 speeding tickets. Okay, when was that? I think she got one this year and then last year. So in the last 2 years, is her license suspended? No, she still has it. Okay, cool. All right. Okay. So I got some notes here. Let me kind of explain how an IUL works so that you completely understand what it can do for you and what it can do for your family. Do you have a pen and paper handy so you can actually take some notes as well? Because I find that when my clients want some information about this, they want to take some notes. Now, time out. The reason why I say that is because I want them to sit down and focus on me, right? I want them to hear exactly what I'm going to say. And a lot of times if I tell them to grab a pen and paper to jot some notes down, because I'm going to go over some important things, they'll grab a pen and paper. And then what are they going to do? They're going to sit down at a table. They're not going to walk around with a pen and paper in their hand. But when they sit down and do that, now they're not doing anything else around the house and they can focus on exactly what I'm going to say. And then when they write down the benefits of it on their notes, now they're going to see it, feel it, and hear it because I'm going to talk to them right up in their ear about it. And they're going to see it and feel it through their pen, right? They're going to see it as they write it down. So now they have 3 senses. And I'm going to go over all the benefits of the policy so that they understand how it works for them. This is how I do this. So you got your pen and paper handy, right? Yep. First and foremost, write down that this is a life insurance policy, first and foremost, not an investment. Investments go up, they also go down, and they cause you to pay taxes. And through a life insurance policy, due to IRS code 7702, you can mitigate the latter two. You don't pay taxes on the growth of the product, and there's no risk of market loss. It doesn't go below zero. So that's one. Number two, it leaves a legacy to the family. Now, are you familiar with a 401k? Yeah, I am. The reason why I use 401k is because most people are familiar with a 401k because a lot of people have it at work or have been offered it. But I use a 401k to compare it to. And I do that throughout the whole process because people are familiar with that. You get some clients that have an IRA, but most people have a 401k. So I'll say, okay, I'm going to kind of compare this to a 401k because most people are familiar with it. Let's say, and I'm going to use easy numbers here. Let's say you have 100,000 in your 401k, and if you died, your beneficiary gets the 401k. But they have to give Uncle Sam his chunk too, even though he's been sitting on his butt your whole life that you've been working your tail end off to earn that 401k. So your beneficiaries are going to have to pay taxes on that. And if they're in a 25% tax bracket, now they're left with 75,000. Your IUL is different. Let's say you have 100,000 of cash value built into that policy and you pass away. Your beneficiary don't get the 100,000, they actually get the death benefit. And due to IRS rules and guidelines, a death benefit has to be much more than the actual cash value to make it a life insurance policy. So in this case, if it's 100,000 of cash value, depending on how your IUL is designed, it could be 150,000 death benefit, upwards of like 300,000 of death benefit. And that goes to your beneficiaries tax-free without any probate. It leaves a legacy to your family. The other thing that it does is it has living benefits. Now, living benefits protect you while you're still alive. IULs are designed for you to use them while you're still alive. And if you don't, then the rest of the money goes to your family, which is what most people want. People love their family and you love your family. That's why we're on the phone together. And they'll say, yep. But living benefits protect you. If you get hurt, sick, or injured, you can pull from that death benefit and the cash value to sustain loss of income. Here's an example. If you get a heart attack, a stroke, kidney damage, liver damage, cancer, 1 in 2 males in their lifetime get cancer. 1 in 3 female get cancer. It's very prevalent. If you ask anybody, I ask this to my clients all the time. How many people do you know that has had cancer or has passed away from cancer? Or do you know anyone? 100% of the time, they all know at least one person that's had cancer. That's how close to us it is. 1 in 2 males get cancer, 1 in 3 females get cancer in their lifetime. If that happens to you, you can pull from the death benefit to sustain loss of income because you're not going to be going to work and you may need some treatment. If you get into a bad car accident, but you don't die, you're laid up in the hospital. Let's say you're in the hospital for 3 to 4 months because you're pretty tore up. You got in a bad car accident. Maybe your hip is detached from your spine. It's happened to one of my friends. You're not going to be walking around. If you can't perform 2 of the 6 daily living activities, eating, bathing, toileting, dressing, medicating yourself, transferring, which is walking, moving about, getting in and out of bed. If you can't perform just 2 of them, you can withdraw from that death benefit and the cash value to sustain loss of income. Because let me ask you this, if you are in the hospital due to a car accident and it's related to work or not related to work, do you think your boss is going to keep paying you? No. You may receive disability, but disability benefits get about 60% of your paycheck. So if you're used to paying your bills off of 10 grand a month, now you get 6 grand a month. The only thing you have is money to pay your bills. And you're married. Your wife is going to have to work overtime to help pay those bills. But she's not only going to be working overtime, she's going to be doing daddy duties as well, taking care of the kids, running them to football, baseball, soccer practice, while she's going up to the hospital to help be with you and coordinate with doctors what to do to help you. So a lot of that goes into it. And so these living benefits are designed to take that burden off, not if the life event happens, but when, because it happens to all of us. You could be older when it happens, or you could be younger, but it's going to happen sometime in our lifetimes. Most people just don't die from a heart attack or a car accident. Most people get a disease or a virus, and then they live and then they die. So these living benefits are very, very valuable for you. That's why I make sure you understand that this is at first and foremost a life insurance policy, not an investment, even though it's all encompassed into one. So all of that is the life insurance side of things. That is the protection side of the IUL. The mechanics of it work like this. When you contribute to the policy, you can do it in many ways. There's some clients I have a lump sum of 500,000. We help them either make a payment every year or they can roll the whole thing into that. Carrier can make the payment for them. We have clients that pay $1,000, $2,000 a month. It just really all depends on what you want to put into the policy and how often you want to contribute to it. Okay. But no matter how you contribute to it, each contribution payment goes to two buckets. Bucket number one pays for your cost of insurance. Your cost of insurance pays for your living benefits, what we just went over, and your death benefit that goes to your family should anything happen to you. That cost of insurance makes it a life insurance policy. And remember, because it's a life insurance policy, is tax-free on the growth you're going to get from your cash value. Now, that leads me into the next bucket, the bigger bucket. The bigger bucket of your contribution payment goes to an accumulated cash value account. That's just a fancy term for saying a savings account. Okay. A savings, what do they do with that savings account? They index it with the market. Now, let me say that again and slow down a little bit because this is where some clients get a little bit confused. They index it with the market, not in the market. What's the difference? Well, your 4Ks, IRAs, stocks, bonds, mutual funds, CDs, Bitcoin, real estate, they are all in the market. What do the markets do? They go up, they go down. When the market's doing well, everybody's happy and hunky-dory. But when the markets drop, what happens, Mr. Jones? Well, people lose money and cuss words start flying too, don't they? Yes, they do. But in your IUL, it's totally different. The IUL participates in the gains. It does not participate in the losses. So let me give you an example. If the index does, and some of the indexes you probably heard, like the S&P 500, it's a famous one. You've probably heard of that, right? Yeah. But let's say it's in the S&P 500 and the S&P does 7% that year. You're going to be credited 7% on your cash value and you'll never lose it again. Way better than a savings account, huh? Yes. Let's say the S&P 500 does 9%. You get 9% that year. You never lose it again. Let's say 2022 happens again and you get, and the S&P drops negative 15%, negative 15 points below zero. What do you get? Well, I don't get anything. Nope. You don't get anything, but here's what's more important. You don't lose anything either. That is the most important part. Let me show you how important that is. Let's say you have 100,000 in a 401k and 100,000 in an IUL, and overnight the market tanks 50%. How much do you have left in your 401k? 50,000. What about your IUL? I don't know. They would say, you don't lose anything. You have 100,000. You have all of your money. You get to keep it all. Now here's where it gets a bit tricky. Let's say the very next year, the market rebounds and goes back up 50%. Now, how much do you have in your 401k? 100,000. No, sir. No. And then I ask them, what is 50% of 50,000? 25,000. Oh, now the light bulb goes on. So now I have 75,000. That is correct, sir. But how much do you have in your IUL? I have 150,000. Yes. So the whole point of me doing this, I did this with all of my clients. The whole point of doing this is to kind of show you the difference in both products, even though the market did exactly the same thing in both products. Market went down and then it went back up. Now, the only difference is one product never lost any money, and that's the IUL. It does not go below zero. You may get a zero one year, but you have a head start the next year when the market rebounds and starts going back up again. Does that make sense? Yeah, that completely makes sense, sir. The other thing that we like to talk about with the IUL is the borrowing privileges. The way I like to explain it, I'll do an example for you. Let's go back to the 401k. We'll use easy numbers again. Same scenario. Let's say you have 100,000 built in that 401k and you want to take a loan out for 75,000 to put a down payment on a house, which you can do. You can take a loan out, but it's mandatory that you pay it back. And if you don't pay it back, then you're taxed, and then you get a 10% penalty unless you're 59 and a half. After 59 and a half, you can take withdrawals and just pay your deferred tax. Okay, your IUL is, well, let me back up. But on top of that, though, even though you pull out 75,000, now you're compounding interest on the 25,000 that's still left in there, and you're still at risk of market loss if the market tanks over. Because we know when bad things happen, they happen fast. If you look at 2008, when the market tanked, it happened fast. Almost seemed like overnight. When COVID happened in 2020, the whole world shut down in a month. Okay. When bad things happen, they happen fast. Your IUL is different. Same scenario. You got 100,000 of cash value and you want to pull out a loan of 75,000. You can do that. You pull out a loan for 75,000. Number one, you can choose when you want to pay it back. You can pay it back when you're alive, or you can pay it back when you're dead. If you don't pay it back when you're alive, it comes off the death benefit in the end. Simple as that. Okay. Now, here's the most important part. And this is one of the reasons why the wealthy have been using these for years. Even though you've pulled out a $75,000 loan out of your cash value, tax-free, number two, you can actually still keep compounding interest on the 100,000 that you've accumulated over time. Even though there's only 25,000 left in there, you're still going to compound interest on the 100,000 that you've accumulated over time in this example. Pretty cool, huh? Yeah, that's pretty cool. So the next step is to reschedule. And then at that point in time, I can show you what we call an illustration. And an illustration is going to show you what you could have in retirement based off of what you want to contribute to the policy, how much your living benefits would cover, and it'll show you the cash value growth when you could borrow from it, how old you'll be when you can borrow a certain amount of money from it. And that's really the fun call. So I'm going to ask you to be in front of a computer or an iPad only to help you so that I can share my screen with you and you can see everything that I see on my screen. But before I get that far, I actually have to do some homework to put everything together for you. And so in order for me to do my homework, I need to know two numbers. And those numbers are what you want to contribute to the policy. This isn't like a term policy where you call me up and say, hey, Shawn, I need $1 million worth of coverage. How much is it? Right? That's a term policy. This is more like the 401k where you contribute to it every single month. And so what I want you to think about now, most of my clients, that are in your type of tax bracket and your type of income, they'll put in, $1,000 to $2,000 a month. Some put in $1,500 a month. I have some clients that stretch because they know retirement's coming up quick and they'll put in $3,000 to $5,000 a month. I have some of them that want to put in 10 grand a month. And then I have some wealthy ones that put in 50 grand, 100 grand a year, that kind of thing. So it really all depends on what kind of lifestyle you want to live in retirement. So what I want you to think about is over the course of a year, when things are going fantastic, you're making some extra money, you got all your bills paid, 11 months out of the year, when things are going great, what I want you to think about is what is the max you would want to contribute to your tax-free retirement? And then on the flip side of that, 1 month out of the year when things aren't going so great, what is the minimum you would want to contribute to your tax-free retirement? And so I have a feeling, side note, guys, I have a feeling of what this person would want to contribute. And the reason why is because I know his income. He has about 7,000 of extra income right here. That extra income is going to dictate how much he wants to spend on his retirement. And so this particular client may say, you know what? I probably want to put in about 2,000 to 2,500. Okay, perfect. So we'll just say 2,000 to 2,500. And then what would be the minimum that you would want to put in no matter what? Oh, probably 1,000. Okay. Now, normally I missed this actually, but normally I would ask them, do you contribute to a savings every single month? And a lot of times they'll say yes, or they'll say no. If they say no, no big deal. If they say yes, then I'll say, okay, on any given Tuesday or Wednesday, whatever, let's say today's Wednesday. So I would say on any given Wednesday, how much would you say is in there? And let's say he says 20,000. So now what I'm going to do is I'm going to say most of my clients like to kickstart it really fast. And so I know you have 20,000 sitting in a bank account in your savings. I'm sure that's for emergency purposes only. But most of my clients, as you probably already know, would not spend the whole 20,000 if there was an emergency, especially like a roof or a furnace or an AC goes out. It's not going to cost 20 grand, right? So out of that money, if you were to dump in a little bit of it, or 50% or 75%, or possibly the whole thing, whatever you'd want, how much of that would you want to dump in the first year just to kickstart it and get it going? Because you could borrow that back out if you need to. Well, I'd probably want to put in 5 grand. Okay. Well, let me do this. Let me design this for you. I'll do my homework here tonight, and then let's reschedule for tomorrow. So based off of, your work schedule, what time do you normally get back in the door from work? Well, I usually get back in the door from between 5 to 6. So I'm going to look at my calendar. I don't have a 6 o'clock, but I do have a 6:30. Does that work for you? Yeah, that works for me. Okay. Can you be in front of a computer? Because I'm going to share my screen with you. It's only going to benefit you. You can do this on a cell phone if you want to. If you're in front of a computer or an iPad, you'll be able to see my screen better because I'm going to show you a bunch of numbers and explain it all to you. And trust me, you're going to love this call because it's super fun. You can't just go out and buy this. You have to qualify for it. If you like the illustration, the next step is to submit a request to the carrier to see if we can even get you approved. And that'll take probably, anywhere from, if they think you're super healthy, it could be 24 hours, could be up to 6 weeks. It really all depends. So you can't just go out and buy it right away. The best thing we can do is just submit a request after if you like the illustration. So I got you down for 6:30. So do me a favor. Can you mark that on your calendar so you don't forget? Because when it's on my schedule, I block that off, and I'm actually taking time away from other clients by doing that. Can you block that off as well? Yes, I can. Perfect. Well, nice meeting you, Joe. I hope you have a wonderful day. Pleasure speaking with you and getting to know you a little bit. We'll chat tomorrow at 6:30. And that is how I do the actual discovery call.